Our measure of the US growth data surprise index has gone positive for the first time really since the mid part of 2014. So that's probably that period of underwhelming expectations was one of the longest periods that we've seen for that state of affairs. And it's, as I said, it's only recently turned more positive in the last month or two. Interestingly, when we look at the index for data surprise, and this comprises of about 10 to 12 indicators for the US. If we look at it, analyze it in terms of how it relates to performance of the bond market and the equity market. So what I'm doing here, I'm taking data surprise index and looking at periods where it's above zero. So data on average is surprising markets. And we look at the movement in bond yields over a 1 month period. What we see here is that the average monthly rise in bond market or in bond yields, US bond yields, has been 4 basis points as opposed to a decline of 9 basis points in periods where the data surprise index is underwhelming expectations. What about for the equity market? What we find here for the equity market performance is periods where data is surprising to the upside, monthly returns being 1.6 as opposed to all other periods, underwhelming expectations, negative 0.6. So it does seem to matter. The index, we've allowed for some lag in the release of data. And as I said, US entering a period of upside surprise for the first time in quite a while. What else have we had out over the past week? Well, just today we had the Japanese wage numbers, and as you can see there in the chart in front of you, real wages have grown now by 1.8% over the year. This is to June. That's the best result we've seen in quite some time, and in fact, if you look over the past 15 or 16 years, it's right towards the upper end. Now, of course, that was helped by some weak inflation numbers. But even in terms of nominal cash earnings, they're growing at around about 1.3%. So a reasonable set of numbers in terms of Japanese wages, particularly in light of the discussion around the possibility of a more aggressive fiscal policy stance. On a slightly more pessimistic note was the release of PMI data for the UK, and in the wake of Brexit, we saw that the manufacturing PMI fell to 48.2 from 52.1, and in fact the service sector PMI also fell into contraction zone, down by about 5 points to 47.4. So this is quite a significant downturn, a very sharp downturn, and we've seen bond yields fall to around about 0.6% in the UK. That's a decline of over 80 basis points since March, and of course we've had the Bank of England cut rates to 0.25 and reinstigate the QE program. So very poor data coming out of the UK. And now we just want to finish up with some data on Australia. We had both the retail sales and the dwelling approvals data, and the retail sales data was quite weak as well. The annual rate, the monthly rate coming in at 0.1 for June, and the annual rate has now fallen to 2.8%. So that's really the weakest annual growth rate since probably the latter part of 2013. So quite a poor outcome, and that is at odds with the upward trend that we've seen in the NAB business conditions. That's the blue line on this particular series. So that's quite a divergence that's opened up between broad business conditions and the state of the retail sector. Mind you, part of the decline in retail sales, this is a nominal number, but the will be related to price discounting, but the volume data was also quite weak. Finally, in terms of dwelling approvals, and that number also showed a decline. As you can see there, the overall number, private total dwelling approvals, has come off, but you must admit it's still at very, very high levels, but does appear to be starting to roll over. And that's both at houses. So private houses have been sort of steady around about that 10,000 level, and units or other dwellings, higher density dwellings, which have basically matched private houses over the past 2 years, also appear to have plateaued. So the two sectors that have been generating a lot of the growth to offset the mining sector in Australia over the past 12 to 24 months, being the consumer sector and also the housing sector, showing signs that we've seen some peak performance from those, and it makes the rate cut from the RBA this week all the more important. Thank you.